Hey everyone, welcome back to Financial Knowledge. Today we're diving into the world of index funds. Whether you're new to investing or looking for a simple way to grow your wealth, index funds might be the perfect option for you. So let's get started. Section 1. What are index funds? So what exactly are index funds? Simply put, an index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to replicate the performance of a specific financial market index, like the S&P 500 or the Nifty 50. Imagine an index as a basket filled with stocks representing a segment of the market. An index fund buys all the stocks in that basket in the same proportion. This way, the fund mirrors the index's performance, offering investors a way to invest in the overall market. Section 2. How do index funds work? Now let's break down how index funds work. Unlike actively managed funds where fund managers pick and choose stocks, index funds are passively managed. This means they follow a buy and hold strategy, investing in the same stocks as the index they track. This passive approach leads to lower management fees, which is great news for investors because it means more of your money stays invested. Plus, since index funds don't aim to outperform the market but match it, they offer a straightforward and efficient way to invest. Section 3. Advantages of index funds. So why are index funds so popular? Let's talk about some of their key advantages. 1. Diversification. By investing in an index fund, you're spreading your money across a wide range of companies, reducing the risk associated with investing in individual stocks. 2. Low costs. As I mentioned earlier, index funds have lower fees compared to actively managed funds because they don't require expensive research and analysis. 3. Simplicity. They're easy to understand and invest in, making them a great option for beginners and seasoned investors alike. 4. Consistent performance. While they won't outperform the market, index funds provide consistent returns over time, which can be a reliable way to grow your wealth. Section 4. How to invest in index funds. Ready to invest in index funds? Here's how you can get started. 1. Choose an index. Decide which market index you want to track. For example, the S&P 500 represents the largest companies in the US, while the Nifty 50 represents the top companies in India. 2. Select a fund. Look for an index fund or ETF that tracks your chosen index. Compare their fees, past performance, and the fund manager's reputation. 3. Open an account. You can invest through a brokerage account, a retirement account, or even a robo-advisor. The choice depends on your financial goals. And 4. Invest regularly. Consider setting up automatic investments to take advantage of dollar-cost averaging, which helps reduce the impact of market volatility. Section 5. Risks and considerations. While index funds offer many benefits, it's important to understand the risks. Like all investments, index funds are subject to market risk. If the market goes down, so does your investment. Also, since they track a specific index, you're limited to the stocks within that index, which might not suit your risk tolerance or financial goals. It's essential to research and understand the fund you're investing in and make sure it aligns with your long-term financial objectives. To wrap it up, index funds are a fantastic way to invest in the market with low costs, simplicity, and diversification. They're an excellent option for long-term investors looking to build wealth over time. If you found this video helpful, give it a thumbs up and subscribe to Financial Knowledge for more financial tips and insights. Got any questions? Drop them in the comments below and I'll do my best to answer them. Thanks for watching and happy investing.